What's up, everybody, and welcome to the Self-Storage Income Podcast. And markets are in turmoil, stock markets dropping, tariffs are unknown. There is so much going on, and a lot of investments have come to a standstill. A lot of cash on the table. People are uncertain about the future. And investors, they're like, is this the right time? Should I be doing this? When you're looking at self-storage, obviously through tariffs, increasing costs to build, develop, that puts development in question, but just even the outlook on where's things going. So during times like this, the question is now the time? Should I be taking action? And is this just noise? Where are the signals that I should be looking for? And how do I overcome either to take action or at least know that I shouldn't instead of just being paralyzed?
The hard part is there's ways to look at this, looking back, historically, saying, hey, when this happened, X, Y, and Z happened. But I mean, it's not a crystal ball, but it gives you at least some data to work from, right? And so I want to touch on that a little bit, but I also want to touch on, your pulse as far as development versus acquisition. But first and foremost, from a market standpoint, let's talk like leading and lagging indicators and what you think, big picture, macro, this all means. Because we look at the stock market's kind of like that leading indicator, then the real estate's kind of that lagging indicator. It ends up happening far later after the initial impacts of certain things. So we want to touch on that a little bit and what you think that impact may or may not look like.
Yeah, absolutely. I think there's a few things, and this is the same thing happened in 2008, and we saw it, and we talked about it before interest rates and with COVID, these indicators and what they actually mean in relationship to particularly self-storage. Before I go into that, though, everybody, we would love it if you could like and subscribe and make a comment in this video. We never asked that. And so I was like, we should start asking that, right? Connor and I, we put a lot of effort into this. We make podcasts. We've been doing this every week for, holy cow, a long time, Connor.
6 years?
Yeah. So
like
guys,
that.
That would help us out a bunch. We are trying to get the word out about self-storage more during this time and have it not just be the hype kind of stuff, but real information, good data that you guys can use and go off of. And that's what you guys could do for us. It lets us know that you like and appreciate the podcast. All right.
Yes.
With that, there's the signal and the noise. This is a very important concept for investors. When we look at self-storage, every asset class, right? First of all, assets directions may be correlated and they may not be correlated. And what that means is if one's going down, another one actually can go up. So not all things are relevant to the other. And also, there are second order consequences, but lots of assets act in inverse. A perfect example of this is over the last 3 years, commercial real estate has been really struggling, right? When the stock market has not. We see indicators and we see things like the stock market crashing, going down. If you look over the last 20 years, there is the difference between a growth and value recorrection and a recession or a depression, right? The stock market retreating, going back, correcting doesn't actually mean that we're in a recession. And it doesn't even mean that we will be in one. That doesn't mean we're not in a recession. And that doesn't mean that we're not going to be in a recession. What I'm saying, though, is it's not a actual cause and effect, right? In recessions, we have stock markets retreat. But stock markets retreat not being in a recession. That's the first thing we need to understand, talk about. Also, real estate and recession is not correlated. We think it is because of 2008.
Right.
But if you actually look past, when you look at real estate assets, real estate in recessions doesn't mean they go down. In fact, a lot of times it goes up. This is really weird to think about. Home prices, how they act and move. But 2008 shaped a vast majority of how we perceive recessions to happen. And that if there's a recession, housing market's going to crash. That was an anomaly. We've had recessions where housing prices have softened and even maybe retreated a little off their highs. But most recessions, that's not only not true, housing prices increased. When we look at commercial real estate, we can find the same type of thing. Depending on the commercial real estate, it will be affected more than others because of its impact to the business cycle, because each commercial real estate type services a different part of the economy. Apartments, for example, are benefited when home ownership, right, is harder and going down. Whereas the commercial retail part, where you have like retail centers, malls, that is benefited as we're in an upcycle and disposable income's rising and consumerism obviously is being driven. And we're not in a tightening phase. When you get in recessions that start to tighten and hit customer and consumers really bad, that's when you have a contraction in retail and also restaurants. Now, with storage, even in 2008, one of the perceptions was kind of off, with people thought if someone's defaulting on their home, they're definitely not paying their storage bill. That actually turned out to not be true. And storage is benefited by movement. So by people moving. So the rise in interest rates, which we talked about in 2001 before interest rates started to rise, and I put that information on the self-storage bubble, the reason the bubble was actually being driven wasn't because interest rates would go up. And that means valuations like cap rates would also go up and there's less buyers and the price of the asset went down. It was because a rise in interest rates would stall the housing market. Why? The vast majority of all homeowners had 30-year mortgages on less than 4%. At the time in 2020, you're talking it was over 95% of all homeowners had 30-year mortgages and they had less than 4% interest rates on that. And right now, we have the largest equity in homes that like Americans have ever had. So the default rate and having housing prices just fall and people move, it was the opposite. We were looking at it. That signal told us that is going to affect the housing market. People are not going to be able to move. That means people won't be able to buy. That means the housing market will stagnate, which 35% of our customers come from the housing market moving. So that signal right there told me about what it would impact in revenue, our actual customers. So a lot of the times you have to look twofold. We have to look at the intrinsic value of the asset, meaning the revenue, what produces it. So in this case, we're talking about the housing market and people moving. We're like, okay, that's going to shrink demand because we're not going to have as many people moving. Higher interest rates can affect the price of the asset on the market. So if you go to buy an asset, you can afford to pay less at 6% interest rate than you could 3%. So sellers have to come off the price. Those two things, though, aren't correlated even necessarily. This is something people have to understand. All over the United States today, we have storage facilities that are not only stabilized, occupancy is growing and rent is growing. So that intrinsic, they're making more money, yet they sell for less than they would have 3 years ago. Yet they're making more money. So we have these two parts of our asset class that we have to look at. The asset and trading it, buying and selling it on the market, and then the business side, which is being affected and what will be affected today. When we look at today, though, the overall macro part of it, storage got hit hard over the past 2-3 years because of the run up. Those lower interest rates and free money made everybody buy houses and trade houses. COVID just made that go crazy.
Yeah, everybody moving.
Moving. And so all of a sudden storage just boomed, right? Then we had the reverse of that where it stalled out, the housing market. People stopped moving and then demand shrunk and came back down to earth. So we were coming off a really high and we had to go to a normal. It's not even that it went low, like it dropped off. It's just it was too high. So the storage market had built for demand that was transitory. It wasn't actually lasting demand. So we really have had to, over the last 2-3 years, adjust as an industry and absorb that. As we look at today where we're at, if we had a recession, or if we're in a recession, how that might help. There's the main way that we could actually see recessions do really good for storage is that if we had a recession and we start to have deflationary effects on assets because they're all going down and we have job loss, the federal government will lower interest rates. Lower interest rates will make the stagnant housing market move. We will be beneficiaries of that. And you go, and we've had this, not argument, but this debate with a few people on, okay, but people are losing their jobs. Well, you got to look at it like this. First and foremost, when people lose their jobs, you say, so they're not buying houses. Job loss, as it moves up, right now we have unemployment at 4%. Historically, we're at 6%. It's actually shocking. We have an employment problem in the United States. And it's not that we don't have jobs. We don't have enough workers. So if we had unemployment rise dramatically, it could take us back to the baseline, what was more of a historic norm. With that said, job loss comes first to people that don't own homes. Why? Because normally people that own homes have careers. They built credit. They're in something for a long time. So most of the time when businesses shrink, the first layer of job losses are on those not career-oriented workers. So the housing market is not, if you had a, let's say, 10% increase in unemployment, that doesn't mean you had a 10% increase in unemployment on homeowners. It's not the same thing. That could be less.
Yeah,
but when interest rates go down, it affects all of the homeowners, 100% of the homeowners, and 100% of the people wanting to buy homes. So it can so vastly outweigh that job loss that it's literally insignificant. Like in our industry. Now, for other industries, that's not true, right? That job loss and unemployment rising will hit them hard. For storage, though, it's actually better to have lower interest rates. So rise in unemployment, a lot of people go, oh, that's going to hurt storage. No, actually, that doesn't mean that at all. In fact, it could help storage dramatically because right now is actually the worst thing we could have. Stagnant housing market, right? Even with that, though, what's happened because of it is a really good thing. We've had a huge contraction in development. Development has stalled out. It's gone. That means we have two sides of demand. You have the demand from customers, which went down because of the high interest rates and stagnant housing market. So when we talk about lower interest rates, even in a recession, that can make that demand go up. But then we have the supply side. Over the last 3 years, supply side and new starts and development has been dropping. And now they're calculating that over the next 5 years, we could see as much as a 40% reduction in actual developments hitting. So supply is starting to even out with a new demand spectrum, even though I would argue that demand side is still vastly artificial because home starts as well as people moving. So transactions are not only at historic lows, they blew past historic lows. I mean, they blew past 2008.
Yeah.
Think about that. Like the worst real estate crisis we've ever had. Today, we have less transactions, even though our population is much, much larger than that. So that's a big deal, right? So I think that looking at where we are in the cycle, a lot of the pain that self-storage has felt, we already felt it. Like if we had a recession, that could absolutely benefit storage. This is what I mean by understanding the drivers of revenue. If you don't look at it like that, you just simply look at it, oh, a recession, that means bad. Where we look at it this year, we're buying a lot.
More than we have in years.
And we haven't in years. Yeah, it's been like nothing. And now we're all full into it. Even though I think people would argue that it's more uncertain than it's ever been. But just because it's more uncertain than it's ever been today doesn't mean it will be in the future. This comes back to the confirmation bias that I talk about. When you're in bull markets, you have a confirmation bias that everybody's winning all the time. And that confirmation bias of stocks go up, I make money, I go. That happens long enough, that becomes the reality. That will keep going. When you're in a down market, the same thing happens. At first, there's kind of denial. Then there's that realization. Then there's that fear. And then there's an acceptance. And right when you have acceptance, it always turns because you're accepting that either there's no value or it's going to lose money, only because a confirmation bias of the market, not because of the reality of the situation. If you look back last year, we had some of the highest valuations that stocks were ever trading, ever. I mean, even today after the stock market crash, we're at an average like 31 multiple to earnings, which is still considered really high. So all of a sudden, this is why you see Warren Buffett over the last 4 years has just piled cash. And it wasn't because he knew a stock market correction was coming or a recession was coming, because he said these valuations don't make sense.
Yeah.
And so you have to wait till the asset valuation makes sense. But that's not how the general market thinks. Instead, they think the confirmation bias of things going down makes a reality that they'll keep going down. We're all like Warren Buffett, or like we look at is, what's the value? Today, we're getting yield on cost of 8 to 11%. That's a buy signal for us. A great yield, low capex, operational improvement in good markets with low supply all day long. We haven't had that for years. So the assets are telling us that it's a good buy. There's noise and there's signals. The signals are what we focus on because the signals outweigh the noise, or excuse me, the noise outweighs the signal. So all of a sudden there's all this negative noise, yet you have positive signals on the things that matter. I talk about this a lot. It's not how much you know, it's what you know. So like if you're consuming information today to try to understand whether you should move forward or be investing, most of what you're consuming is noise. So if you want to know more and you're like, I'm learning everything I can. If you learned 20% of what like is out there, what you even need to know, that 20% is the most important part. And that is the signals. And so when we look at that, that's where I focus on the signals and what it means in the long run. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description. This happened to us in 2009. We were buying assets. I was even building some, and people were like, you're a moron. We're in a real estate crisis. And they're like, you know that asset is going to be worth less next year. And I'm like, yeah, you're probably right. Like, I bet you the street value. And they're like, well, then why are you buying it? Because I could buy it next year at a lower price. And my answer was, no, you can't, because I'll own it.
Right.
And I own it at a valuation that is great. Yeah. So even though the street price may go down a little, the returns that I'm getting from cash flow upside, it's perfect. So what happened is next year, what the street value may have been went down maybe a little, but then the next year it plateaued. And then from there, it was just all up, right? Because the return I was getting on it was great. So I wasn't trying to time markets. And I say this a lot. I don't time markets, but my money does. And what I mean is the signal on the returns and what I can get, how safe it is, meaning the next thing we saw in 2009, development was gone. So there was no development starts. So I'm like, we have good demand curves. We see stabilized rents. We see stabilized occupancies. And so that market value's down low, even though it's gone down every year. And even though it might go down even more, this is a great, historically great buy. I mean, when we were the first ones to do a CMBS loan in like the entire Northwest afterwards. Oh, wow. Some of the assets we bought, we were the literal only people that even went to buy. We were so dumb. Yeah. And when I even looked at it, I was like, yeah, we got like probably 10 years. This could take 10 years for the markets to restabilize and everything. I was very wrong on that. But it didn't matter because the cash flow that we were making and the improvements that we could make on that asset
made
Perfect.
sense.
Exactly.
Yeah. No, and that's the thing too, is like anybody that's starting out, that's what you really have to focus on is, does it make sense for you and your expectations for the asset?
And
That's
your
it.
plan, what you're doing.
Exactly, man. I see it so often in our communities and stuff, in the inner circle and the community, is people are just, they want to know like what's a good deal.
Yes.
And when should I pull the trigger and when should I not? As if there is this idea of some like for sure target to hit, and that target, I mean, it's totally up to you and whatever makes sense. And obviously, you guys looking at those assets back in the day and said, hey, cash flow is good. This is good. We're buying it. We're moving forward. It wasn't, again, you're looking at the indicators and not the noise.
Yes.
And let's say I'm out there right now today trying to get my first deal. You talked about it's what you know. It's that 20% that's going to set you up for success. At a macro level, what do you like to look at? And at like the market level, I know we talk about this a lot, but I want to separate these two.
Yes.
Macro level, market level. What's that 20%? What are those indicators that we should be looking at?
So if I'm looking at a macro level, let's take both the rise in interest rates and COVID. Let's forget about 2008. When COVID came around, we had 3 months that were terrifying. Because it was like, this is either Armageddon or I don't even understand, right? Like
sure.
It was just, there was
Everything's
so
over,
much unknown. As we started to sit through that, we had to say, what is the reality of the situation? Okay. We had to gain some clarity, take out all the hype, everything else. The one thing though, that I think we got after a few months was that the range at which people were talking about, right? Whether it was real or not, the solution to it and how that might play out. And the first signal we got was the government came out and said, we won't let markets fail. That was an immediate buy sign for me, because when governments bail out and when governments evolve, guess what they do? They shoot up asset prices. This was the same thesis that I had in 2008. The government's like, we're going to bail everything out. And it's like, buy as many assets as you can, because government spending and involvement makes assets go up. That's why the rich get richer. And so when you look at that government involvement, that was my first buy signal. The second was solution. And the answer was, there is a solution. They'll have a vaccine. We'll figure out more information or whatnot. And so right when that was happening, banks started to shut down, everything else. We got deals that were pennies on the dollar for only a few months. And we just went and bought them, even though we didn't have all the answers. The government said, markets, we won't let markets fail. We'll intervene. That means they're going to support asset prices. Boom, right there. Then I turned and looked on the macro side. We looked at solutions, how long it may go on. And the answer to us was clearly a couple years, maybe, right? That we would have whatever. And that the unknown part of it was largely inconsequential. So we had a range. Is there a death rate or is there a problem above a certain rate? Well, okay, what's that range? Here's the high end, here's the low end. And it turns out everybody was so vastly wrong on even that. I mean, we were below the lowest range that they even had. The point being is, though, we had an idea, and then markets were priced for Armageddon. But Armageddon wasn't going to happen. It didn't mean it wasn't going to be bad. That's not what I'm saying. But we had assets that were coming off $10 million. It was as if the value had just gone away, but that wasn't true. So when I look, first of all, national, or macroeconomics, I want to look, the signals that I look for is the cost of money, right? And direction. So we look a lot at the Fed. What is the direction going? The cost of capital, cost of money. I'm looking at your ability to build. So what basically the signals are, what causes investors to buy, right? Cost of money, perception of the future. What causes investors not to buy? And what causes prices to go down or go up? When I look at those things, are those things directly correlated with the asset's intrinsic value? And lots of times they may not be, like today. So the cost of money prohibits people from buying. That doesn't mean the asset's revenue are going down. So I look for a disconnect, right, on there. And so what that means is it's just on sell. That's all that it means. The supply and demand imbalance is from buyers and sellers of the trading of the asset. That signals to me, right? What the opposite end of that was the opposite signal. Interest rates are going to rise. So when we looked at that signal, we said, what does that mean? That means cap rates will rise. That means we will not see this kind of demand, right? And that means we'll have trouble. So what did we do? We refinanced, and this was before interest rates rose. We refinanced all our assets, took all that cash in, and got ready. And so that was a signal to us, right? When it was booming and everybody was great, right? When we put that whole thing, I was interviewed by multiple banks for a lot of time that made a ton of money off shorting self-storage assets after my review. Because they're like, we've never seen anybody make a bearish case on self-storage. It was, and I'm like, it's because once again, you have noise, confirmation bias versus the signals. It doesn't mean we know. The next side about it that we look at, though, is the local market. So we have the big macro, then we have the local. The reality is, everyone, the local trumps everything on that side. Everything. So I'm looking at deploying huge amounts of capital in lots and lots of markets, right? We want to deploy 100 million in capital, and I'm going to do that across the United States. That bigger side matters more to me because I'm investing in institutional assets. I have to buy lots of them in lots of different places. So that'll tell me, am I going to have lots of options in lots of places or fewer options in fewer places, and I won't be able to deploy as much. When you are looking, though, let's say you're buying your first asset or one deal, the macro side is almost irrelevant to you. I mean, literally. So then all the signals to me matter this. I'm looking at that 5-mile radius, that city. Is employment rising? What is the employment tied to? That's where the macro might enter. So if that city has all of these low-level IRS people and they make up 50% of the employment in that city, I might not want to be buying because they're gutting the IRS. So I'm like, I don't know, maybe everybody would fight, right? Outside that, though, if I have a diverse workforce, maybe it's even like a farming community. A lot of people don't understand. In 2008, farming communities did great. Like really small towns did fine. Why? Because asset or commodities were rising. And so when you look at that national, how it affects there, but most of the time it's going to have minimal impact except for the individual location. 2021, when we had the tech bubble that popped, Idaho, we didn't know we were in a recession. We grew through the recession. People made more money. Like it was very isolated to certain markets. California was hammered, right? And so because that one market, California, New York, a couple other markets were hammered so big, it had an effect on the global GDP, which made us go into a recession. Individual GDPs, though, all across the country were not affected. So when we look at that concentration of employment, that's what I care a lot about. That's a signal. The next thing is supply and demand. That's it. I say this all the time. You can be an idiot and you will be wildly successful in a market that has demand. You could be the smartest self-storage investor ever, and you will lose in a market that loses demand. And I have. My thesis, maybe macro has been good, but something happened locally and it hurt me. We had a perfect example of Bixby. We had public storage that opened up 3 miles down the road, and we had a contraction in overall demand, okay, because of the high interest rates. When that happened, though, the players in the market did something I guess we didn't know they'd ever do because no one had ever seen it. They dropped a $200 rate to $40, $60. Mind-blowing, right? I mean, they dropped it by 60 to 75%. And because they were open, they flooded the inventory, or they flooded the market with inventory on prices that were super cheap. That location was so adversely affected compared to all our other locations during the same time and the same macro events. Why? It had nothing to do with the macro events as much as it did that isolated storage facility. So if I'm looking at an area, is that supply-demand metric changing? Is that localized supply? If it's not, everybody's renting. Places are full. We've got higher rents, and it's kind of remained that way because we haven't had any new supply in 3 years. I go to the city and I ask the city, do you have any proposed storage facilities? Do you have land that's available? Is anyone going to build? And if the answer is no, I know, okay, well, I have at least 3 years until I'd have to worry about that because if somebody started today. So now I can project out that supply and demand. That is a signal. Okay. The next signal would be looking at what I'm buying. I'm looking for a good location that has a bad owner operator. That is a signal to me. You have a good location, you have good demand, you have visibility, you have a decent asset, but you are being ran poorly. Price then comes in after that. And I think a lot of people get the noise on this side mixed up because assets go to market at a 5 cap. It sells at an 8 cap, but you see it and you're like, oh, that's too expensive. I'm not going to buy it. And so people pass it by, even though it didn't sell for that.
Yep.
So when I say we create deals, that's what I mean. If I look at a deal and I say it's worth $1 million and the owner's like, lists it for 1.5, but I go, this is a good upside. It's a good market. I want that asset. We just don't pass it by. We go and negotiate because none of the assets price that they're going to market, they're not selling for. It's just not, they're not trading.
No, we've seen it time and time again. And you've got to have those conversations. And it's funny. Our friend Nate, he had posted the other day that he'd been putting off going and talking to the storage owner. And he posted on Instagram. He's like, hey, yeah, I put this off for weeks. And, I connected with him today, learned a ton about the facility and the market and this and that. Guess who's already, sold their facility? The guy that he should have talked to weeks ago. Had he actually gone in and not overlooked that or not taken the time, it's hugely beneficial. Just get in, start the conversation, start building the relationships. Don't pass it by.
Yeah.
Don't take the listed price as the sale price or the value to you. Figure out what the value is to you, what you're willing to pay, present it to the seller, see what happens.
Exactly. We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it going to look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. So when I'm looking at signals, right, it's supply demand. We're talking location of the asset. We're talking about general demographics and your customers.
I was going to say, we talked employment. Are you looking generally we're looking at population too, right?
Yeah,
growth,
population,
right?
We want to see growth. Now so I bought and we started out in very rural, small markets. And some of those markets weren't growing. But the supply demand was so off kilter because they weren't growing. Nobody had been built or anything else, but they were also smaller facilities. And when we bought them, we didn't underwrite like there'd be an appreciation, right? It was like literally, I can take income from here to here, nothing else. We don't build in a sell to get our money back because in those smaller markets, especially if they don't have population growth, lots of times you don't have a vibrant marketplace of assets trading. And so I wouldn't ever expect that. The other problem with it is if you have one that's actually decreasing, your customer base is getting less and less. So I look at that, and if I see the city's getting smaller, then I have to assume 10 years later, the demand from customers is going to be less, and it could be a lot less because people aren't living there. It's the same thing if you have a growing market. The demand from customers is going to be a lot more in 10 years, right? So we want to see, especially now, because we buy big assets, we want to see that population growing. I need to know that I'm not fighting against the market because I don't want to fight against the market because when you do that, you lose. So for me, I'm like, no, we're going to buy in an area. We buy not because we expect the market to make us, but we buy expecting that we did our underwriting, that the market would support what we're going to do. And that's the improvement, that money on the table I talk about of that asset. If the market goes up, if valuation goes up, that's the cherry on top. So when I look at it, I need a market that supports the assets, that I'm not going to lose demand. And then I need an asset that is in a good location, that is surrounded. We have, you have low supply or not any new supply coming in. And then we start to work with the owner. Those are the main things. Those, by the way, trump all the national ones. So that's why we buy in up markets, down markets, sideways market. Even if over the last 2 years, when interest rates went up, we didn't buy a lot. It is not because interest rates went up, we thought demand was going in. It's because sellers were so accustomed to selling their facilities in Timbuktu, Missouri for a 4 cap, as if they were in LA, that they were so disconnected. It took 2 years for sellers to readjust their expectations of value. So it wasn't that national stuff. If the expectations of value had been more in line with the reality of the situation, we would have still bought.
Man, that's such an important thing to recognize, because outside looking in, it seems like everybody's got this crystal ball. They've got this ability to predict things, and like you guys, you did your refinance at the perfect time just because you knew that X, Y, Z, or you just because you're looking at those indicators and making data-driven, educated decisions and saying, hey, we should buy or we shouldn't. It's not like, we're not buying because interest rates went up. It's like, no, we're not buying because valuations are so insane. Like it doesn't pencil. It doesn't make sense.
That's why when you look at it, you're exactly right. When you look at it, it looks like you time markets.
Right.
It looks like Warren Buffett actually knows when the market's going to go up or down. He has no clue. Zero. If you have somebody that actually thinks they know when the market is going up and down and that's how they're going to time it, that terrifies me. The reason being is they think they know something they cannot. And even worse, they're making buying decisions on information that they are essentially not fully aware of and they don't actually know, instead of looking at the actual assets. It means they're gambling. They're literally gambling. Whereas when you look at value-based investing, the individual asset, what you're buying that business, you're buying it at the buy box that you have, the returns I need, what makes sense, what is truly its value. Then over time, it just happens to look like you time markets. That's why we got out of buying storage before 2008. We didn't have any debt and we had cash-based businesses that we worked on. Then after 2008, 2009, 10, we bought a ton. It looks like we knew. I don't know 2008 was going to come, right?
Yeah.
People lose sight of those fundamentals. They get caught in the noise, and the noise starts dictating decisions. And that's when you lose as an investor. Short-term thinking makes you susceptible to short-term market changes. Focusing on the value of the individual asset and long-term thinking makes you rich.
Yeah. Well, I think it's so important too, because you're looking, another differentiating factor here is that you're looking at what's happening right now today with the data and information you have right now today. It's not like where we think anything's going to go with rates, with interest rates, with anything going on. It's what is happening right now today? Where can we drive rates for these units? What is the market actually supporting or not? What's the demand for those certain unit types right now today? The only thing I guess you could say that you would consider future-wise is that future supply that may be coming onto the market. Like you're saying, if you're talking to cities and they're like, we've got a 200,000 square foot facility, at this major crossroads that's, 10 feet across from where your facility's at.
And you're like, this might get rough.
Yeah, going to be hard. But
I think too, one of the things when I look at, I have always studied macroeconomics. When I went to get my MBA, which I had no need for it at all. It didn't do anything for me. It wasn't like I was going to get paid anymore. I literally just went because I'm like, holy crap, I have so many questions that I don't know even where to get. So I just went and peppered professors with answers. That was why I went and got it, because of my own curiosity. But when I look at that, the largest reason that I try to understand these things is an allocation of resources into the business of self-storage, meaning that we have our acquisition department. We have all of these people out here. If I'm looking, saying, hey, we're getting into a situation where our amount of opportunities is probably going to grow, like we're just going to have more buying opportunities, then I need to be staffing up and getting ready versus not. It doesn't mean I'm buying that individual asset though because of that. Does that make sense? Like I'm building out infrastructure in the business. I'm getting capital back into the business. I'm protecting it. I'm watching it. It is an overarching management as opposed to an individual buying or selling decision. That's where people can get lost. Because when we talk about these things, first of all, they are important because there is second, third order consequences, right? But it doesn't mean you have to know them or even understand them to take advantage of the outcome, right? Listen to the podcast. We'll tell you what's changing. We'll tell you why interest rates may matter, everything else. But no matter what's happening on that macroeconomic side that we're talking about, a good deal is a good deal, everybody. Yep. You can buy and execute. You don't need to know that to understand the microeconomics of that location, of that asset, that value add, and negotiating with that owner. That's what matters. This stuff will tend to explain to you what you're seeing in the marketplace, so you better understand and can learn how buyers and sellers act within this asset class in this market in given conditions. It can help you understand how your customers are thinking and acting in different economic situations, and that will be helpful for you and it will be important. But that's never the reason you should make a buy or a sell decision.
Yeah. Just become the asset whisperer.
That's right.
Let the asset tell you what's going to happen and what's going on as much as you can. High level before we wrap up, what do you think all this means, this uncertainty for development?
Contraction. I think we're still going to... Tariffs will drive up cost. We have tariffs with, especially for us in storage, still aluminum. That's cost for building storage was already super high due to inflation. That inflation, we're talking about, it doubled the cost of building a storage in a couple of years. Lower occupancy and lower rents that have just come back down to earth, right? We have not seen a retreat in building cost. Higher interest rates now make that building cost even higher, right? Yeah. And now if you have tariffs coming in, a lot of markets do not get rates to justify the cost to build. You can't make amount of money at that. We're buying assets that are this is under replacement cost. And just because it's under replacement cost doesn't mean it's a good deal, by the way. But we're seeing that. So with those conditions, especially in bigger markets and bigger, nicer assets, that really hits you and it makes it so it's not economical. So we will see a large contraction continuing, I think, in development for a few years because there's a tail. So once again, development is always the last, because if we get those signals, if the market turns today, it takes developers years to turn around and get markets and get assets sold. So they're always behind. This is why developers notoriously go bankrupt, because they're always behind. By the time that they started something, the market changed, they can't change it, and now they have to deal with the consequences. So once the markets turn around everything else, it will take time for those developers to catch back up and realign supply. That means I think we have a good runway here for more demand, higher occupancies overall, and higher rates overall. But your individual 3 mile market, if somebody is building or started and they can't stop and they're going to put it out, you will see a disproportionate effect on those markets. You will see much lower demand and lower rates in markets where any new supply is coming out today, because we don't have a robust moving market to fill up inventory. So the market may be stable, high occupancy, but somebody comes and builds a bomber facility and it could just tank that 5 mile radius until it can absorb it. And absorption rate is lower because there's just less people moving. That's why it disproportionately affects it. And they spent so much money, they got to cover their costs. So they're just get people in. So it's way more competitive on new inventory. So we're very concerned about that. If there's development going on to a local market, it will change the fundamentals of that local market today more than we've seen in a long, long time.
Yeah. So back of the napkin, if you're going to pull the trigger or not on development, what's going to tell you it's good?
$1.50 a square foot in rent a month is kind of a baseline for me. We at these costs too, smaller facilities get very hard because some of the costs don't go away. So your average per square foot cost to develop a storage, and by the way, guys, I'm talking about a decent storage. I'm talking paved, I'm talking gates, I'm talking security, nice facility. It doesn't need to be a Taj Mahal. It doesn't need to be an A-class asset, but a fundamentally good facility that people want to rent. Because if you're building too, you need to build something nice because you need to get higher rates. You need to attract those people that'll pay it. So with that said, the smaller ones, right, the cost that is fixed to development, it's disproportionate. If I added on 100 units, some of those costs don't go away. So it just absorbs it and makes those fixed costs lower. So today I want to see $1.50 a square foot or more in revenue. I want to see high occupancies, and I want to see rates that have been they may have gone down a little, but it was temporary and they restabilized or they're rising. I don't want to catch a trend going down. I need to see the support level on those rates. And I need to see that has changed. And I want to understand why. Did the rates go down? Was there new supply? Was it just the macro side? They went down, but then quickly corrected. That's fine. That's short-term stuff. So from there, I need to see that. I also need a market that is growing because I need that churn that will allow new inventory to fill up, because you don't have any customers already. So that churn is what gives you all the new customers to fill up. So I need to have that.
Yep.
So $1.50 a square foot a month or more. I need churn, market growth. I need stable occupancy and rates and rising, and no new supply. And I can't be competing with somebody else opening. That is killer. Those are what we're looking for today.
I love it. No, those are all huge pointers. I know a lot of people have all those questions, man. They're like, hey, is it development time? Is it acquisitions time? And so there's all the questions. Both. But yeah,
we're doing both. Because
again, if it makes sense, it makes sense.
It makes sense. And you got to realize too, when you have markets that have nothing being developed, there's a development opportunity.
Yep, exactly.
So, when we were originally looking, like say 5 years ago, we were flying around. We went all over the Midwest. We were just jumping from state to state.
Yeah.
And we were looking at, then we went to Montana and hung out with Rob Bailey, and he was looking at doing his facility, everything else. Yeah. So when we were doing that, we were looking, I'd say probably 80% of the markets in the United States made sense for development. It was building costs were still low. Occupancy and rates were going up. Today, I think it's literally inverse. 20%, maybe 20%. And I'm not talking about population as 20% of the population like LA. No, I'm talking LA is one market, then you have another market, right? Yeah. So if you looked at all the markets that you could build in, I think 20% are probably viable for self-storage and the rest aren't.
No, that would make a ton of sense.
For new build.
Yeah.
New build.
Well, this is another thing that comes to mind as we're talking about this, just the huge opportunity there is if you can find those facilities that have expansion potential.
Yes.
Where you can take advantage of not only the current cash flow and business, but then you can actually really make that development aspect and that value add aspect make a ton of sense.
Your cost per square foot is lower as you build. Why? Because you already have. The land's already part of it. You already have approvals. You're just building buildings to it. It is, I agree. Me and Connor have always loved expansions. It's always been something we've looked for, one of our favorite modes of operating because of those things that Connor just mentioned.
Well, dude, we
get our cake and eat it too.
Yeah, you get not only the value add, but that just massive equity creation that you can achieve through development. It's just amazing, dude.
It is. So, and two, you get to buy the asset in times like this. You buy the asset, you can see the market. Instead of just building from ground up where you're kind of guessing at the market. Oh, I have an asset. I own it. I can see which units are popular, which ones aren't. I can see how many people are calling a day, how many people are trying to move. So then you can build to that market. It's a great way to go.
Yep. I love it. Well, what do you think?
Right on, dude.
That was solid, man. Yep. Really, really good stuff. I know there's a lot of uncertainty out there. Hopefully that adds some clarity for everybody out there. If you got questions.
By the way, the newsletter, we go a lot more in depth too. So during the podcast, everybody, it can be hard. It's hard to show a lot of data. Now, I know this is on YouTube, but still it's principally audio, right? And so even though we are on YouTube, of course, you can go watch it. It can be harder for us to show a lot of market data, numbers. So that's why we have YouTube videos that actually show the case studies. We have like 4 case studies of assets coming out right now. And then we have our newsletter, which gives a lot of the data. It's a way for us to disperse that information so you can actually see graphs, numbers, everything else. So make sure you guys are subscribed to the YouTube channel and get the newsletter so you can actually see a lot more of the data that we talk about.
Exactly. No, it's hard to make sense of visuals without having something to look at for sure. So, thanks everybody for everything. Really appreciate your support. Leave us those reviews and we'll catch you next time.
Talk soon, everybody.
Thanks.